And good morning once again, options traders. Well, I thought this would be a perfect time to talk about the risk of hedging volatility because we're starting to see, as we often do, some whipsawing markets. And I hear a lot of traders talking about, I'm trying to set up some hedges for my portfolio. Well, you've got to be really careful if you are trying to hedge volatility. And here's why. First off, remember that higher volatility means that we are expecting potentially higher prices and potentially lower prices. Traders often forget this. They think that higher volatility means that prices are more likely to fall, and that's not at all what the definition means. It just means that we are expecting a broader range of potential prices. So when we're talking about volatility, it means higher probability for higher or lower stock prices. And because of that, call and put prices will rise. So if we see, let's say, a bell curve sitting over our current stock price, remember that the bell curve is always situated right over the current stock price, and the width of the curve, which is the standard deviation of those prices, or what traders call volatility, shows the expected low and high ranges under this volatility. But if we are having higher volatility, we're expecting higher volatility in our markets, that bell curve gets shorter and wider. And that means that, yes, we have the ability for prices to move higher, and we have the ability for prices to move lower. And because we have the ability for higher prices, that's good for call prices. And because we have the ability for prices to move lower, that's good for puts. And that's why call and put prices will rise under higher volatility. But you've got to be careful. Because, let's start with long calls. As volatility rises, yes, call option prices rise. But if you buy calls and volatility rises, traders believe that they'll see a gain. And this is where you can step into a trap. So for instance, let's say here's our $100 call. And if we have maybe 30 days to expiration with, let's say, 20% volatility, we will move from this expiration curve in black to this in red. Now, if we go to 40% volatility, you're going to see it shift out like this. 60% going to shift out even further. So if the stock is right here at 100, right there lined up with the red as the current call price under 20% volatility, and in green is at 40% volatility, so an even higher price, and in blue is at 60%, so yet an even higher price. So yes, it's true. If we are in a Black-Scholes model and we just keep cranking up volatility, that option's price will rise. But here is a problem. The Black-Scholes model does say that rising volatility equals higher option prices, calls, and puts, but this assumes all else being equal. This is the big key right here. This is what sets the trap. So it means that the model is assuming that the stock price, the strike price, the risk-free rate, time to expiration, everything stays the same. But in the real world, what is most likely to change under higher volatility environments? Probably the stock price. And that's because volatility equals risk. So while options like higher volatility, investors don't. As volatility rises, traders are willing to pay less for the underlying shares. So these investors are going to start bidding down these share prices. So falling share prices mean lower call prices. So we've got a little bit of a tug of war going here. Increased volatility says call prices are going higher, but investors are saying, ooh, things are getting more volatile. Let me bid down the price of these shares. And that's having a downward pressure on the call prices. So if we go back to our call option here in blue, priced at 60% volatility, right there, yeah, we might get this price up near $5. But I can hold volatility constant at 60%, push the stock price down to 92, and we're right back to pretty much the same starting point. So you can see that it becomes a tug of war. And this is why you have to be so careful when you are hedging volatility. Yes, all else being equal, rising volatility increases option prices, both calls and puts. But rising volatility also decreases stock prices. And so the thing that you have to keep in mind is if you had to choose, long puts are most likely to rise in value. And that's because they will definitely increase from the rising volatility. But if stock prices fall, they will also pick up those gains as well. See, that's not true for the call options. The long calls may or may not go up in value. The higher volatility is driving the prices higher, but there might be lower stock prices that are pushing them lower. So this is why you've got to be so careful if you are using options to hedge volatility. The pricing model says that the options are going to go up in value, but that's assuming that you keep the stock price the same. Keep that in mind when you're setting up your hedges, and it'll keep you out of a lot of trouble. And so for anyone who'd like to learn more about the arts and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. It's all at optionsa2z.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.